Hey, hello everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 10th, 2026. Hey, I hope you're doing well. I hope you had a good trading week. I hope you were having a nice weekend, and I appreciate you coming to my weekend review podcast. I hope you are going to find it helpful. So, the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades, all the positions that I had from last week. We're going to talk about when I entered the trade, why I entered the trade, what the setups were, what the confluences of signals were of when I took the trade. We're going to talk about how I position size correctly based upon my account size and the volatility of the market. We're going to talk about where I place my emergency stops, where I place my end of bar stops, how I'm going to take partial profits if the market starts moving my way, when I'm going to go into trailing stop mode, and then ultimately how I am going to exit the position, either if I get stopped out or at certain oversold or overbought levels and resistance levels above me. So we're going to talk about when I entered the trade, why I entered the trade, and how I am going to enter these trades moving forward. It was a pretty good week for me. I had some really great winning trades. I did get stopped out of a handful of trades as well, but that is just part of trading. But anyway, I hope you're going to find this helpful to kind of see what my trading process is, how I look at trades, how I enter trades, how I manage trades, and ultimately how I try to put myself in a position that if I have a winning trade, it can be a large winning trade. And if I have a losing trade, trying to structure it so that the majority of time it is a small losing trade. And that's really the key in trading. Being patient with your winners and having a process that you can follow with your winners, that you can have a potential outsized game, but always trying to keep your loss small. If you do that, your trading life's going to be a lot better. Your trading balance is going to be a lot better as well. I've been trading for 30 years and I can attest that is the truth. So that's what I'm going to try to show you today, try to teach you today. After we take a look at all of the positions that I have, we're going to talk a little bit about trader psychology. Trader psychology really is the most important skill in trading, the ability to create a plan and to follow the plan. Sounds easy, but it's not. You know, I know many traders around the world. I teach many traders around the world, and the common denominator that I see all the time is the inability of people to follow their plans. It is so important. But if you want to be a profitable trader, you have to do it, and that comes back to trader psychology. So I've got a good trader psychology section today to go over, and I hope you're going to find that helpful. After that, I did go down through my watch list last night. I go down through it every Friday night, and I look for potential trades for the upcoming week. Now, these trades are not where they need to be. If they were, I probably would have already potentially taken the trade, but they're getting close. They're within striking distance of some good setups, some confluences of setups, major moving average, order blocks, and the majority of them, the order blocks and the moving averages together, which is really the most important. So hope you're going to find that helpful. You can follow along, see how they do, but I've got some good ones I'm going to show you. And if they get there, I will potentially take the trade next week. So if you find anything of value in this podcast today, I really would appreciate it if you just take a second and hit the thumbs up button. It really does help the channel grow and helps YouTube get a lot more, or share the video more often on their platform. And over the past month, boy, the channel's really grown. I'm really grateful for that. Grateful for you for helping me do that. So let's go ahead, run the U.S. legal disclaimer, get that out of the way, and then we'll get started. So hold tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast. here, and here. Thank you so much.
All right, thanks for holding through that with me, and let's start taking a look at the potential open trades, daily trades that I am in. And let's start with Shopify. So I do trade essentially 7 different type of strategies. In the podcast today, you're going to see 3 or 4 different ones. Depending on the market, I use different strategies. Some strategies just haven't come into play with the market conditions that we have. But today, what you're going to see mainly is you're going to see order blocks. You're going to see major moving averages, the combination of order blocks and moving averages, and abandoned baby. So that's what we'll be covering today. So let's start with Shopify. I did enter Shopify here on the 18th of November at $140.47. So you can see that's been a really nice trade. But let me explain why I took this trade. I took this trade because it rejected the order block. So the green box is the order block. It rejected the high of the order block. You can see during the day we came into the order block and then we closed back above it. And that is essentially why I took the trade. So, but we have to go back in the past and look for an order of why this order block started. So this order block started in the past, and let's go all the way back to here. This is the order block that happened on 9/2/2025. So first of all, why is this an order block? So let me explain what an order block is. The way that I trade order blocks, people trade order blocks in all sorts of different ways. They have all sorts of different rules. But like most traders, you learn a strategy and you kind of put your own spin on it. So for me, this is the most simple way to look at order blocks. It's the easiest way to teach order blocks, and the way that I use them and teach them works quite well. So an order block, the way that I trade them, starts with a swing low. A swing low is here on the 27th. The swing low is a low that has a higher low to the left and a higher low to the right. So you see that? This is swing low, or higher low to the left, higher low to the right. That is your swing low. So it starts with a swing low. After the swing low, you have to have a swing high. Well, here's your swing high. A swing high is a high that has a lower high to the left and a lower high to the right. So we have a swing low followed by a swing high. Then the next thing I need is another swing low that's lower than the first swing low. Well, this is a swing low, higher low to the left, higher low to the right. Okay, so we have a swing low, we have a swing high, we have a lower swing low. Okay, check, check, check. Now, when you have this in place, swing low, swing high, lower swing low, you need to reference back to the first swing high, which is right here. So if you have swing low, swing high, lower swing low, then in the future, if the market goes above that first swing high level, which it did here, right? Swing low, swing high, lower swing low, and then here we went above that first swing high. Now the market structure has changed to the bullish side, okay? Now, I am not a breakout buyer. This would be a breakout buyer signal, and it obviously would have done quite well. But when we have the swing low, the swing high, the lower swing low, and then the breakout, as soon as it breaks out of that swing high and changes market structure to the upside, now I know exactly where my order block is. It is here. It's the lowest closing bar prior to market structure change, which happened here. So as soon as this takes out that swing high, now the lowest closing bar, the high and the low of the lowest closing bar is the order block. So I take the high and the low and I move that into the future. Now, I need to wait for the price to come back into the order block. So if this is the order block and you go out 2 months and we're at all-time highs over here, is it fair to say that looking back using hindsight 2020 that smart money was buying this area? And the answer is, yeah, it's pretty obvious when this is the order block and it skyrockets up to here that smart money was buying here. So in the future, if you come back into that smart money area, will it be smart money again? Maybe, maybe not. But in my experience, 30 years of trading, it is smart money again more often than it is not. So once we have a swing low, then we have a swing high, then we have a lower swing low, and then we break structure to the upside. I just am patient and I wait for the price to come back to that smart money area. Again, if you're up here, was this smart money? Yeah, clearly it was. So it's more than likely if it comes back to that smart money, it will be again. You can see after we had the swing low, swing high, lower swing low breakout, it moved up and then it came back to where? Almost to the penny to the smart money area before it took off again. So that is a order block. Swing low, swing high, lower swing low, market structure change. The order block is the high and low of the lowest closing bar before market structure change. And I bring it into the future and I wait for the price to come back into the smart money area. Okay. And that's what happened. That's exactly what happened. It was very high. It came back into the smart money area. Now, when it comes back into the smart money area, there's three different ways that you can enter the trade. You can enter the trade with the rejection of the high of the order block, which you can see is why I took this trade. We went into the order block, closed back above it. That is a rejection of the high. Alternatively, you could get in with a rejection of the low. Alternatively, you could get into if you have a major moving average or an RSI level inside of the order block, then uh, I can take trades inside the order block if I have those moving averages, um, RSI levels, or sometimes I'll make my own key level inside there, which I'll show you on some other trades, okay? So anyway, this is why I entered. Rejection of the high of the order block that was formed in the past, I entered at $140.47. Now, as soon as you enter the trade, if you find your trade, okay, I'm getting in the trade, this is my trade. Now I have to decide how many shares of this am I going to buy. And that is, for me, the way that I figure this, and it's quite easy but quite effective. You take two inputs. You took how much is in my trading account and what is the value of the two ATR. ATR means average true range. Average true range is what the market is expected to move on any one day. I take that number and I times it by 2, and that helps me position size. So let's just assume I have $100,000 in my trading account. All I do is I take 1% of that. 1% of $100,000 is $1,000. If I had $200,000, 1% would be $2,000 and so on. Okay, so $100,000 trading account times 1% is $1,000. I divide that by the value of the 2 ATR. Right at this moment, it's $12. So I divide it by 12. And that would tell me to buy 83.3 shares. So I would just round it down to 83 shares. So this is very important. A lot of traders just trade the same amount of shares depending on the market volatility. But if the market volatility is higher, really, I trade fewer shares. If the market volatility is lower, I trade more shares. And this dividing 1% of my account value by the 2 ATR will always keep me on the right side of volatility, because if volatility is very high, then dividing that $1,000 by a higher number is going to give me fewer shares. So it's very important, in my opinion, to position size based upon volatility. So, okay, now I know how many shares I'm going to buy, 83 shares. So I entered with the rejection of the high, the order block at 140.47. I bought 83 shares. The very first thing I have to do is reference back to the 2 ATR. Well, the 2 ATR was $12. So as soon as I buy my 83 shares here with a rejection of the high of the order block, I need to place my first stop. And my first stop is my emergency stop. And my emergency stop is very simple. Entry price minus whatever the 2 ATR value was. Right now it's $12. So entry price minus $12. So why is that important? It's important because if I have 83 shares and it goes down $12 to my emergency stop. How much have I lost? I've lost 1% because we did the math, right? Losing 1% is not fun, but you can recover from that, okay? But you have to have a point in a trade where you're wrong, where you just know you're wrong and your rules tell you to get out. And so that's why I place my emergency stop. And again, if I get to my emergency stop, I have lost 1% of my account. Now, the good news is that this only happens about 5% of the time. The other 95% of the time, if I have a loss, it's going to be a much smaller loss than 1%. And this is what is called the end of bar stop. So the emergency stop, 2 ATRs below my entry. My end of bar stop, it depends on what strategy I'm using, but if I have a rejection of the high of the order block in this case, my end of bar stop is going to simply be a close below the low of the order block, okay? And if it closed below the low of the order block just barely, I would get out and I would have a loss, but it would not be as large of a loss as if I hit my emergency stop. So I hope that makes sense. So I always use two stops. An emergency stop, which is always 2 ATRs below my entry, and the end of bar stop, which is it's going to be different depending on what strategy I take. But if I take a rejection of the high of the order block, then the stop is going to be just a close below of the order block, which again is much closer than my emergency stop. So, okay, so we have the rejection of the high of the order block. I decide I'm going to enter the trade. I do the math. I figure out how many shares I'm going to buy. 83. I place my emergency stop 2 ATRs below, and my end of bar stops a close below the low of the order block. Now, the next thing I do is I take my entry price and then I look for the value of the 1.5 ATR. The value of the 1.5 ATR is $9. So as soon as I enter and I know where my emergency stop and my end of bar stop is, I take my entry price plus 150, the value of 150, which is $9, and I place a line above. I place the orange line 1.5 ATRs above my entry. So what is this? This is trailing stop mode. If I enter the trade and then in the future I get to the trailing stop mode, now it doesn't mean I do anything. It just means now I'm in trailing stop mode. And all that means is when I'm in trailing stop mode is that in the future now, if I have a close below a previous bar's low, I'm going to exit half of the position. So, in general terms in trading, when you enter a trade and it starts moving your way a certain distance, that's great. But if it starts moving a certain distance, then you want to start tightening up your stops because you don't want to give all of that profit back. So you start to tighten up your stops. Well, there's a lot of different ways you can tighten up your stops. Just move them up, right? But the way I prefer to do it is if I get to trailing stop mode and then I have a close below previous bar's low, I sell half my position. Selling half your position reduces your position size, reduces your risk by half, right? So if I have a close below previous bar's low after reaching trailing stop level, that is how I tighten up everything. All right? Okay, so everything I have talked about so far, as far as emergency stop, end of bar stop, going into trailing stop level, these are all defensive moves. Or in other words, if I take the trade and it moves against me, I need to take action. Defensive moves. But I also like to play offense in my trading as well as defense. Just like any good sports team, you have to have a good offense, you have a good defense. Well, okay, my defense is really good. I've got emergency stops, I've got end of bar stops, I go into trailing stop level, but they're defensive. So I like to play offense. And the way I play offense is I take a certain amount of my position off if it goes in the direction that I want it to each day. So not difficult. Let me show you exactly how I do it. So I'm in this trade currently, and let me show you how I'm going to do the math for Monday. It's very simple. I just take, and I need to do this every day, right? After the close, I can do it. So I need to take the closing price. The closing price is 164.48. So 164.48. I just take the closing price. That's all. Now I look for the value of the 0.45 ATR. The value of the 0.45 ATR right now is 270. So I take the closing price, 164.48 plus $2.70. My first profit target for Monday is 167.18. So on Monday, if it gets to at least 167.18, I'm going to take something off. And how much do I take off? It's really simple. 10% of however many shares I have gone into the day with. So if I go into the day with 50 shares and it gets to my first profit target, I take off 5 shares. That's it. So I place 3 profit targets every day. The first profit target I showed you, closing price plus the value of the 0.45 ATR, my first profit target, 167.18. But I place 2 more every day, so I place 3. So I take my first profit target, 167.18, and all I do is I add the 0.45 to it again, plus 270. My second profit target for the day, 169.88. And again, if it gets there, and I went into the day with 50 shares, I would sell another 5 shares there. Okay. So, and then to get the third profit target, I take the second profit target and simply add the 0.45 to it again. Third profit target for the day, 172.58. Okay. If I went into the day with 50 shares, I place the limit order in my trading platform, 5 at the first profit target, 5 at the second, 5 at the third. Third's 172.58. So if the market goes, so I place these profit targets every day. If the market goes down, obviously I don't hit any profit targets and I have to recalibrate and recalculate for the next day. But if I have a decent day up, maybe I hit 1 profit target. If I have a really good day up, maybe I hit 2 profit targets. If I have a great day up, maybe I hit 3 profit targets or more, right? But I really truly believe that when the market is moving your way in any significant fashion, I want to take a little. I want to lock in a little. It locks in. Market can't take that money away from me anymore. It reduces my position size, which is also a benefit. Because really, the smaller and smaller your position size gets, the easier it is for you to manage your position. And I'll show you in positions today that, boy, I am really glad I sold into some strength before the market turned against me. So I'm a big fan of taking partial profits every day if the market gives them to me. Okay, so I've kind of covered the basics. And now let's just see how I manage the trade. So let's start all over. Okay, I got into the trade on Shopify at $140.40 on the 18th of November. Why? Because we rejected the high of the order block. So I entered 140.47, position size based upon the volatility. I placed my emergency stop 2 ATRs below. If it gets there, how much do I lose? 1% of my account. My end of bar stop is much closer to my entry, and so a close below the low of this order block is my end of bar stop, which is about 133.74. After I enter and know where my emergency stop is and my end of bar stop, I then place my 1.5 ATRs trailing stop level above, and off we go. So let's follow the trade. So I enter, next day up, great. Hit a profit target right off the bat. Next day gaps open very nicely. I hit 2 profit targets on that day, so I'm selling into the strength, and I also got to trailing stop level. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I get out of half. Next day down, no, excuse me. Next day up, I hit a profit target. Next day up again, hit a profit target. Next day up, but not enough for a profit target. And then here on the 1st of December, we have our first close under the previous bar's low after reaching trailing stop level. What do? I take off half the remaining shares that I have, and I locked in a gain of 5.72%. By taking off half the remaining shares, I tighten everything up by half. Okay, so I sold half of the remaining shares, but I still have half. And next day takes off. Perfect. Hit a profit target. Next day, can't remember if that one hit a profit target. No. Boom, big day up here. Again, I sold into that strength. We had a profit target here, and then we went down, and we had a few more days up where I hit a profit target here, profit target here, then we move sideways, and then we move down, and then the next day we move up, profit target. So the remaining shares that I have on this particular trade doing quite well, up 14.63%. So listen, if we head straight down and we close underneath the order block, what would I do? Of course, I would get out. If it just starts moving sideways, we have a little up and a little down, what do I do? Well, I take partial profits every day if it moves up. Now, if we get to a 65 RSI level, which we got close over here, but not quite, but if we get to a 65 RSI level, now the 5 EMA comes into play. The 5 EMA is this very thin blue line, the 5 EMA or the 5 EMA. If we get to 65 RSI or higher, and then we close below the 5 EMA, then I will exit the entire position, okay? Because if you get to 65 RSI, the trade is really moving your way, and really tightening up your stop using the 5 EMA is very helpful. Conversely, if we reject the 70 RSI, that's a very overbought level, and in that case, I would sell half my position, the remaining shares that I have, and then after that, if I have a close below a previous bar's low, after rejecting the 70 RSI, then I would completely get out of the trade as well. So I know this sounds complicated. It's really not. But if you're new to this and you're like, Greg, how could I remember all those rules? Really, it's really not that difficult. And this is what I teach my students how to do. So, but the 65 RSI and the rejection of the 70 RSI, that's kind of the end of the trade to the upside. But right now we are not near those levels yet. So in the meantime, if it heads down, I'll just keep it unless it closes below my end of bar stop, or more likely it will move sideways, have some good up days in which I'll take profits. It'll have some good down days that I'll just stay in the trade. So the remaining shares on this trade using the rejection of the high of this order block up 14.63%, which is really good trade. All right, let's go to USO. Boy, I have a lot of positions to go over. Anyway, hopefully this gives you some, lots and lots of examples of how I manage these trades. So I got into oil USO here on the 20th of October. Why? Again, this is a rejection of an order block from the past. The green box is the order block. We're way up. We came way back down to the order block, and here we rejected the high of the order block. I entered at 67.81. I position size. I placed my emergency stop. As always, 2 ATRs below my end of bar stop is just a close below the low of the order block at 66.03, which is much closer to my entry than my emergency stop. I place my 1.5 ATR trailing stop level above, and let's follow the trade. The next day, boom, right up. Great, perfect start to the trade. I hit a profit target. Next day, up strongly again. I hit multiple profit targets, and I got to trailing stop level. Next day, up again, big time, hit 3 profit targets. So I took a majority of this trade off into that strength. Okay, clearly we're in trailing stop level. We did that the day before, and then we consolidated for a couple days, and then here was our first close below a previous bar's low after reaching trailing stop level. What do? I take off half the remaining shares that I have for a gain of 4.97%. Okay, then we move all over the place. We move up. When it's a decent up day, I take profit targets. We move down. I don't do anything. And then here we go up again. I'm selling into that strength. And then we go down. And then we gap up. I hit more profit targets here. I hit more profit targets here. And then we go down. And then we move up here. And there's going to be several profit targets in there. And then we come all the way back here. But do you see how this still stayed in the order block? Had it closed under, I would have exited the trade, but it did not. It tested the bottom of the order block, closed above. That kept me in the trade. Thankfully, up again, profit targets, profit targets, profit targets, profit targets, profit targets. But think about this. Look at all the profits that I took into this big, huge run up. When it came all the way back down here, I was thrilled that I had taken those profits while I had them. Actually, even if it would have closed below and I would have gotten out, I still would have had a profitable trade because of what I did here. And it kept me in, and I'm glad it kept me in. I don't have a lot of shares left yet. But anyway, just a good example, in my experience, in my opinion, of why it's good to take a little when the market gives you something. So the remaining shares that I have on this particular trade, and I don't have a lot of remaining shares, but the remaining shares that I do have up 4.18%. So pretty good. And again, this is a rejection of the high of the order block. Just the same as Shopify. Okay, let's go to FXY. FXY again is an order block trade. This time it was the last two I showed you were rejections of the high of the order block. This is a rejection of the low of the order block. You can see we went slightly under the order block, closed back in it. I got in 58.33. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below the low of the order block. You can see where I entered. It's very close to that anyway, which is ideally what you want. You want to be very close to your stop so that if you're wrong, you can be wrong a very small amount. If you're right, you have a lot of upside potential. So I got in with the rejection below the order block at 58.33. I placed my emergency stop 2 ATRs below. My end of bar stop's just simply a close below the low of the order block. I placed my 1.5 ATR trailing stop level, 1.5 ATRs above my entry. Next day, boom, multiple profit targets, started off the trade really great, and the very next day I got to trailing stop level because it went up so much. The next day down, but didn't close below. Next day up, sold more shares into that move up. And then the next day we have our first close below the previous bar's low after reaching trailing stop level. I locked in half of the remaining shares that I sold half of the remaining shares that I have for a gain of 0.78%. Then we move up. Next day we move up, more profit targets, down, no profit targets, up, selling into that strength, which obviously I'm glad I did. Then we move down, but didn't close below the low of the order block. Then we have a couple days up where I sold into that strength. Same with here. Then we have a big down bar, didn't close below the low of the order block, kept me in the trade. And then we moved up here where there were some more profit targets, and then kind of consolidation. And then look what happened on Friday. Friday, I almost had to get out of the remaining shares, but it didn't. It closed barely above that order block. So you can see this order block level here is an important level, but it closed in. Monday, if it closes below, I have to get out. That's it. Okay. But even if it closes below here, I still have overall a profitable trade. Why? Because I'm selling into strength, because I got into trailing stop mode and sold halfway up here, right? So the remaining shares that I have on this trade are down 0.19%, not a lot, but overall, because of the process that I use, because of the partial profits at the 0.45 ATR levels and the getting out of half at trailing stop level, I'm still positive on the trade, but the remaining shares, yes, are down 0.19%. And again, this was using a rejection of the low of the order block. Okay, let's go to Microsoft. Microsoft, I entered Microsoft here on the 21st of November. This is a rejection of the bottom of the order block. You can see during the day we went below the order block, yet we closed back in it. I entered at 472.10. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. And again, look how close I am to it to begin with. Place my 1.5 ATR trailing stop level above. The next day opens higher, goes lower, was under the order block during the day, but I wait until the end of the day to make my decisions, and it closed back in, kept me in the trade. The very next day, again, opens down just a little, went down significantly during the day. Had it closed there, I would have just gotten out, but it was reversed and was able to close back in the order block, kept me in the trade. The next day, we gap up, great. I hit a profit target. The next day, up again. I hit another profit target, taking a little off, little by little. Now I'm in trailing stop mode. Next day down, next day up. Did hit a profit target here, and then here on the 3rd was our first close below a previous bar's low after reaching trailing stop level. What do? I took off half of the remaining shares that I have for a gain of 1.33%. Okay, then we head back up, here I sell into that strength, and then we go down here I have a profit target, and then we head back down. But look, as soon as we got into the order block, it held, so it kept me in the trade. Then we up here on this day, we have a nice up day, or again I sell into that strength, and then we go sideways, nothing's really happening. We come back down, and again for 3 days test the bottom of that order block, but every day it goes under, but was strong enough to close back in, kept me in the trade. Here on the 7th, we had a big up bar, so I sold into that strength, and we're still above the low of the order block, so I am still in the trade. And so the remaining shares that I have on this particular position up 1.53%. But again, am I happy that I sold into the strength when I, up here, up here, up here, up here, up here? Well, sure I am, because we're lower than that now. So again, this is a rejection of the bottom of the order block, remaining shares up 1.53%. All right, let's go on to the next trade, excuse me, which is Home Depot. Okay, interesting trade here. And I'm going to introduce something that I don't talk a lot about, but this happened, and this is why I took the trade. So I took the trade here on the 6th of January. Why? Well, first of all, we have an order block. And let's talk about why the order block. Swing low over here, swing high, lower swing low, and then this bar here takes out the first swing high, changes the market structure to the upside. When the market structure is changed to the upside, we look for the lowest closing bar before the market structure change. Here it is, the high and the low of this bar. We move it into the future. Okay, well, it did break out, but then failed. Came here, came down here, came down here. I bought it here. Why? Okay, well, just simply it's a rejection of the low of the order block, right? But so were these. So why didn't I buy these? Well, I'll show you. So, but first, again, this was below the order block, closed back in the order block. That's a rejection of the low of the order block, okay? But in addition to that, take a look at the bar before. The bar before was red. The bar that I entered here was green. So why is that important? Well, these red bars, blue bars, green bars, these are the Elder Impulse System from Dr. Alexander Elder. Very famous trader, very famous author. I actually studied one-on-one with Dr. Alexander Elder in Vermont. It was really great. Learned a lot about, his stock trading strategy. And it is part of what I do and what I teach in my trading and my lessons. But part of the impulse strategy is this red bar to green bars. Now, you've heard me talk about abandoned babies. Okay, abandoned babies are important because you have a shift in sentiment from very bearish to very bullish very quickly. And in a few minutes, I'll show you one of those trades. But when markets are very bearish and then they go very bullish in a very short amount of time, that's a good indication that in the future, prices are going to be higher. Now, I'm not going to get into the whole math of what's going on between these red and green bars, but when you are red, there's MACD is going down, trend is down, it's bearish. But when you are green, that means MACD is getting stronger, and the trend has changed to the upside. So when you go from red to green, you're going from really bad, bearish, but then when you go to green, the very next bar, everything has changed from bearish to bullish very, very quickly. And that is important, okay? And so that's the confluence for the trade. The primary signal is that we rejected the bottom of the order block. Okay, that's clear, that's easy. Rejection of the bottom of the order block is a legitimate entry. But the cherry on top of this trade was the red bar to green bar at the same time. And that is what made me decide to take the trade. So I entered here on the 6th of January at 349.23. I position size, bought the right amount of shares. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. The low of the order block is 345.27. I place my trailing stop level 1.5 ATRs above, and here we go. The trade right off the bat opened up, went up, hit a profit target into that strength. The next day opened way down, even went below the low of the order block. Had it closed below here, I'd had to get out, but buyers came in at that level and reversed much, much higher, hit multiple profit targets on that day. And then you can see Friday was up huge again. I think I hit 4 profit targets on Friday, selling into that strength. So I am in trailing stop mode. Okay. And also, interestingly enough, on here, we are at 68.29 on the RSI. So remember earlier I was telling you that if we reject the 70, I'm going to take off half the position. It didn't quite reject the 70, but Monday, if this does go above 70 and then close below 70, I'm going to sell half the remaining shares. And then if that happens, then in the future, if we have a close below a previous bar's low, then I'm completely out of the trade. And then remember when I was talking about going to 65 RSI or higher, and then the 5 EMA comes into play, the thin blue line? Well, clearly we're above 65 because it's 68. So no matter what happens here, if now we close below this 5 EMA, I'm out of the trade. So this one is just on autopilot. If it rejects a 70 RSI, I'm going to sell half. If it closes below a previous bar's low after rejecting the 70 RSI, I'm going to be out of the trade. Or if it anytime in the future it closes below the 5 EMA, out of the trade completely. If it continues to go up, great. I'll write it up. I'll continue to sell profit targets into that. So this is a really good trade. The remaining shares I have are up 6.78%. But again, this was a combination of a rejection of the order block or rejection of the smart money area, and again, the red to green bars. Now, if you can put the the Elder Impulse System on your charts, do, and you will see when you go from red to green, more times than not in the future, you will be the price will be higher. But you can't just use the red green as a system. I mean, look over here. Here was red and it went green. Did it work? Well, kind of no. Because by itself, this doesn't work. You have to combine it with a legitimate entry signal. So if you have a legitimate entry signal with a red to green, then that's a different story, like this particular trade. So, okay, remaining shares on this one up 6.78%. UNH. Okay. Another order block, but this time, you remember how earlier I talked about having an order block, and then sometimes in the middle of the order block, you'll have moving averages or RSI level or a level that I put in myself? Well, this is one of those examples. So here's your order block. Now, you see the green line that I drew in the order block. Why did I draw this green line? Okay, this green line is a key level within a key level. That's why I love when there's moving averages inside an order block, because the moving average by itself is a key level, but the key level is inside a key level, which is the order block. Key levels within key levels. Okay, so I drew my own key level. You can see there is a 100-day moving average. I could have used that, but I'm referencing this bar on the 10th of December. Why this bar? This bar is a very strong up bar and a large bar. If I have a strong, large up bar, I know from a Fibonacci standpoint that there should be some good support at halfway of that bar. So the low plus the high, the midpoint of that bar, if it's a strong up bar, I know there's going to be Fibonacci support there. So I grabbed the midpoint of the bar and I moved it forward. Now I have a key level, which is the midpoint of this bar, which is 324 key level inside a key level because it's an order block, right? So again, what made, well, let's start here. So here we have the order block. We come into the order block, and this particular day, the day that I entered the trade, it rejected my halfway point. It rejected the 324 level. During the day, it was below it, and then it closed above it. Okay, so I entered here 324.90. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below 324, my midpoint line. Okay, look how close I am to that point anyway. If the next day it's simply closed below, I just got out for a small loss. That's it, right? Okay, so we reject the midpoint line in the order block. I enter 324, emergency stop 2 ATRs below. My end of bar stops a close below 324, the midpoint line. I place my 1.5 ATR trailing stop level above. The next day goes up a little, actually closes a little red, but held above my key level. Next day goes up a little. I think I had a profit target on that day, but clearly it closed above 324. Next day up, did hit a profit target into that. Next day down a little. Next day had a big day intraday at the top, so I did hit a profit target. Next day down. And then the next day I hit multiple profit targets into that strength. And then I also got to trailing stop level. Okay, didn't do anything. Now I'm just in trailing stop level. The next day up again, very, very strong, multiple profit targets. Okay, next day up again, I sold right at near the top with a profit target. And then here on the 7th was the first close below the previous bar's low after reaching trailing stop level. I took off half of the position and I locked in a gain of 5.12%. Now, we at the top here, we did get above 65 RSI. And remember, if I get above 65 RSI and then I close below the 5 EMA, I'm out of the trade. Well, on the day that I got out of half because it closed below the previous bar's low, it did go under the 5 EMA, but then it closed above it, kept me in the trade. If it, to make it simple, if it closes below the 5 EMA, I'm just out of the trade because my rules tell me if I get to 65, then it close below the low of the, if I close below the 5 EMA, I'm out of the trade. You can see I almost had to get out here on Friday, but it did end up closing above the 5 EMA, kept me in the trade. So very simple going forward. If we go down and close below 5 EMA, I'm done with the trade. If it continues to go up, I'm going to sell into the strength. If we reject the 70 RSI, I will sell half. And then after that, if I have a close below previous bar's low, I will get out of everything. So it has to go down a little bit more for me to get out, or it has to go up higher and reject. And the remaining shares that I have on UNH up 5.58%. Again, this was a combination of a midpoint of a large up bar, key level inside the order block key level. Remember, key levels within key levels, that's how I get my best results. Okay, so remaining shares up 5.58%. Coca-Cola. Well, this was a monster, everybody. I talked about this in last week's program. So last week we were up here, and I said, look, we have a nice order block below us, and this order block stems from back here on the 3rd. Swing low, swing high, lower swing low, market structure change, and again, after it changed market structure, I knew that the lowest closing bar prior to market structure, we had an order block or we had a smart money area. I brought that into the future. It continued to rally, and once it was up here at its highs, I could look back and say, hey, the people, and once the order block was formed, I could look back and go, hey, was smart money buying there? Well, yeah, clearly it was buying there. Okay, so I know where the smart money was buying. Let me bring that smart money into the future. If it gets back there, it's not for sure that it's smart money again, but it's more likely. And there's the edge in the system. Okay. Now, I entered here on the 7th of January at 67.51. All right, Greg, but it didn't reject the bottom of the order block. It didn't reject the top of the order block. You didn't have a midpoint line. There wasn't a moving average. Why did you enter? I entered because on this particular day, we went under the 30 RSI, yet closed above the 30 RSI. Okay, this is a deep dip buy signal, right? I use deep dip buys all the time. Deep dip buys involve the 200-day moving average, the 250-day moving average, the 300-day moving average, and a rejection of the 30 RSI level, which is over here. So on this particular day, we went under the 30 RSI, but then we closed above the 30 RSI. Is that a legitimate signal? Yes, it is. But that legitimate signal happened inside of the key level of the order block. Okay, would I have taken an under 30, over 30 just by itself? Maybe, but probably not. Again, because I like to have confluences of signals. Well, I had a really good confluence. Under 30, over 30 in a smart money area. Okay. In addition to that, everybody, I don't know if you can see this kind of thicker gray line here. This is the negative third ATR channel. 92% of prices, when they get to this level, stop going down, start moving sideways, or go up. So I had a lot of things happening here. Rejection of the 30 RSI, legitimate? Yes, check. Inside the order block, legitimate? Check. And a rejection of the negative third ATR channel. So I got in here 67.53. I placed my emergency stop 2 ATRs below. My end of bar stop would simply have been a close below the 30 RSI because that's why I got in the trade. It went under 30 RSI, closed over 30 RSI. So therefore my stop on it, my end of bar stop on it is in the future if it closes under 30 RSI. I placed my 1.5 ATR trailing stop level above and next day took off like a freaking rocket ship. I think I hit 4 profit targets into this day, maybe 5, can't remember now. So I took a lot of profits and I took a lot of my position off into this day. And then look what happened again on Friday, up again. So I kept selling into that strength. So the remaining shares that I have on this Coca-Cola trade, up 4.23%, pretty good. By the way, look, red bar, green bar. In general, is that a good signal? It is, because it means very bearish to very bullish very quickly, and we had followed through the next day. So it's a good example of under 30, over 30, inside a bullish order block, key level within key level, with a very good risk to reward ratio. The next day, I had it closed down, I don't know, 30 cents, 40 cents, 25 cents. I would have gotten out and taken a very small loss. So that's the key. Setting yourself up, looking for key levels within key levels with good risk to reward ratios. So if you're wrong, you can be wrong small. And if you're right, you can have a nice, large, outsized gain to the upside. It's exactly what happened. So under 30, deep dip buy and order block combination this trade. Really great trade. Up for remaining shares up 4.23%. CPB. All right. This is Campbell Soup. Campbell Soup has lost 50% of its value. Not very exciting stock to buy. But just like Coca-Cola, I bought this on Friday for the exact same reason. Again, let's look at Coca-Cola. Why did I buy it? Under 30, over 30 in an order block. Worked out great. Campbell Soup. Why did I buy it on Friday? Under 30, over 30 inside an order block, and it also rejected the negative third ATR sound. So the setup is exactly the same as Coca-Cola. Is it going to react the same way? I hope so, but it doesn't have to, right? So why did I enter under 30, over 30 inside an order block? I got in on Friday, 26.43, which is exactly where it is. I position size correctly. I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level above. Look at the RSI, 30.29. If on Monday it closes below the 30 RSI, closes at 29.99, what do? I just get out. Small little loss, no biggie. If it all hits the fan and it goes down huge, well, I have my emergency stop down there to hold me, right? If it moves up, great. I'll start taking profit targets. If it gets to my trailing stop level, I'll go into trailing stop mode. Makes sense? So no matter what this does, I know exactly what to do. And trust me, everybody, this is a key thing in trading. If you don't know exactly what you're going to do at all moments, it's stressful. But if you have a plan and you know exactly if it moves sideways, I know what to do. If it goes up, I know what to do. If it goes up big, I know what to do. If it goes down a little, I know what to do. If it goes down big, I know what to do. It's a much more holistic way to trade. Having a process and follow the process. Get yourself a process, whether you learn it from me or someone else. Get it, do it. More importantly, follow that process. I can give you the best process in the world, but if you don't follow it, it doesn't matter, right? So brand new trade, deep dip buy, order block combination in 26.43. It's completely even at this moment. I just got into it on Friday. And we'll go to the last open trade here, which is TLT. All right, TLT is not a order block trade. It is not a major moving average or deep dip buy trade. It is a abandoned baby trade right here on 12/23, abandoned baby time. What makes this an abandoned baby? Abandoned baby is very simple. The previous day you have to gap down. See how the previous day we opened here and we gap down? Gap down at the open is very bearish, right? But look what happened the very next day. We gapped up. So a gap down followed by a gap up makes an abandoned baby. And so why is a gap down and a gap up important? Same thing I showed you with the red bar to green bar. It shows that sentiment has changed very quickly in a very short amount of time. Very bearish sentiment followed by a very bullish sentiment. Now, I don't take abandoned babies at any place on the chart, but when you're down near the negative third ATR channel, you're down near the 30 RSIs, or it happens in an order block, that's the time I want to take it. So did I take it here on this day? No. Could I have? Yes. When you have an abandoned baby, when you have a gap down followed by a gap up, the key support level is the top of the baby, the high of the baby. And so I bought the next day when it came down, tested the high of the baby and bounced off it and closed above. That's when I bought. Now, with this particular setup, it's a little different than the rest. With the rest, I go into trailing stop mode, I take partial profits, all the stuff I showed you. End of bar stops, all that. When I have an abandoned baby, these are really strong. They don't always work, but it's over 70% of the time that they do. This one is kind of a set it and forget it. When I have an abandoned baby, bearish or bullish, I position size like I always do, 2 ATR below emergency stop. But, so I place my 2 ATR stop below. But on this particular trade, I place a 4 ATR profit target above. So if I'm wrong, I'm going to lose 1% of my account. If I'm right, I'm going to make 2% of my account. So I have a 2-to-1 risk to reward ratio. That's it. I set it and forget it. I set my stop here. I set my profit target here. My stop 2 ATRs below, my profit target 4 ATRs below, and I just let it go. I just let it go. Eventually in the future, I can promise you it's either going to hit my stop loss for a loss of 1%, or it's going to hit my profit target for a gain of 2%. And based upon the statistics of abandoned babies, in my experience, about over 70% of the time, I will make twice as much as if I lose. Okay, so if 70% of the time I'm going to make twice as much as I'm risking, that's a pretty good proposition. Imagine if you were flipping a coin, and when you won, you got paid twice as much, and when you lost, you only lost half. Yeah, you flip coins as long as you keep your eyes open, right? It's the same thing. And in the meantime, pays a dividend, over 4% for the year, pays it monthly. It's great. It's perfect. So, so far, it didn't start out so great. Started down, didn't get to my 2 ATR stops, so I held the course. So this particular trade at the moment is up, not a lot, up 0.24%. Hey, by the way, look, red, green, red, green. Is that good for bonds? Yeah, yeah. I wouldn't have taken this trade just based, if I was taking trade on Friday, would I just take it based upon this? No, I wouldn't. I would want it to be an order block and 30 RSI, major moving average, something like that. But doesn't hurt, is what I'm saying. So again, 2 ATR stop, 4 ATR profit target, set it, forget it. One of these two are going to hit. If I lose, I'm going to lose half as much as if I win and make twice as much. Okay, that's good. That's asymmetrical risk. And again, this was a bullish abandoned baby, rejection of the high of the baby. And that's why I got into the trade. So up 0.24%. So, all right. Well, those are all the open positions. I know there was a lot of them there. So, but again, I hope these examples show you the repetition of why I got in the trade, how I'm managing the trade. Now let's go to these are all great trades, really, all doing really, really quite well. But trades don't always work out. So I did have to exit 4 trades this week that did not work out. And let's take a look at those now. Netflix. I have gotten into Netflix multiple times over the last month and a half. None of them have worked. None of them have worked. I had the signal, I got in, got out. But the key is the losses were small. Okay. Now, I got into Netflix here on the 6th of January. Why? Well, remember what I'm telling you about key levels within key levels. We have an order block. And inside that order block, we have a key level. Now, let's see. We're going to have to go way back. Well, this is a good example. These order blocks have memories. This order block formed, if you can believe it, 4/4/2025. Okay. Swing low, swing high, lower swing low, market structure change so that the lowest closing bar prior to market structure change is the order block. Now, I have a green line inside the order block. This green line is the halfway point of this bar on the 9th of April. Large up bar, halfway point, boom. So now you know why. And then Netflix started its fall from grace. Now it has gotten all the way back to that order block. Now remember, I put that midpoint of that large up bar way back there at $90. So I took the trade on the 6th of January because during this day we went under that midpoint $90 level and closed back above it. That's a legitimate trade. So I entered at $90.60, placed my emergency stop 2 ATRs below, placed my 1.5 trailing stop level 1.5 above, and my end of bar stop is simply a close under that $90 level. Well, the next day it held, but what happened on Friday? It closed below. So what do? I get out, right? Was it a loss? Yeah. Was it a big loss? Not really. 1.44%. So I'm out. Listen, Monday, if it goes back and closes back over that $90 level, I get in again. If it keeps heading down, great. Now I'm not in it, fine. And if it does, I'll revisit maybe a rejection at the bottom of the order block. But this is a very good example. I was very patient. I waited for this trade for a long time. It signaled, it held for a couple days and then failed. I'm not getting married to it. I just got out. That's it. Again, if it goes back above, I can get back in. So I did take a loss on this trade for 1.44%, but I'll be watching it carefully next week again. So a loss of 1.44%. Oh, excuse me, I had to take a break there. Somebody rang the doorbell. Okay, next one is MO, Altria. So I entered Altria here on the 3rd of November. Why? Rejection at the bottom of the order block. Very simple. Here's the order block from the past. During the day, we were below it. We closed above it. I entered at $55.60. I position size. I place my emergency stop as always 2 ATRs below. My end of bar stop, very simple, just to close below the low of the order block. Look how close I am to the bottom of the order block anyway, right? I entered 55.60. The low of the order block is 55.38. I mean, it's hardly anything. So it was a very good risk to reward ratio. Okay, I placed my 1.5 ATR trailing stop level above, and then what happens? Next day goes up, hit a profit target. Next day goes up, hit a profit target, sold into that strength, pull back, up, profit target, pull back, and then we have a nice up bar here where two things happen. I take a profit target, and I also get to trailing stop level, which is important. Here on the 13th was our first close below a previous bar's low after reaching trailing stop level. What do? I take out half the remaining shares for a gain of 2.06%. Next day, we're up a little, kind of sideways, another up bar where again, I sell into the strength. I keep reducing my position size. Then we move down, but still staying above the stop. Then we move up, profit target, and we just kind of go up and down. As it goes down, I'm not doing anything. As it goes up, any significant day, I hit a profit target like here, here, and here. And then sideways and then down, and then boom, we collapse. Okay, I had to get out of the remaining shares that I had on the 6th of January for a loss of 0.8%. Okay, no biggie. It's a small loss, but overall, was I positive on the trade? Yeah, of course I was, because I sold into the strength when I had it, and I sold half of the shares here for a gain of 2.06%. So was it a big gain? No, it was not. Had I not used profit targets or gone into trailing stop level, I would have had a loss of 0.8% on the trade. Not fun, not bad, but because of the process that I use of partial profits and trailing stop level, this still turned into a winning trade. So I hope you can see the value of using those partial profits and going into trailing stop mode. And then as soon as I got out, look what happened. Next day down again. Oh, I'm glad I got out. And then rocket ship up. Well, wasn't in the trade. That's just what happens, you know. You get in, sometimes you get stopped out and it goes right back up. What do? That's just part of trading. So the remaining shares on this trade, loss of 0.8% because we closed below the low of the order block. But again, overall, it was a positive trade. UNG, all right, this was my stinker for the week. Really, this was my stinker. I got into UNG on the 2nd of January with the rejection of the high of the order block. Wasn't a tall order block. So I got in 1207, position size, placed my emergency stop 2 ATRs below, placed my trailing stop level 1.5 ATRs above. Next day, gap down, but it closed in the order block, kept me in the trade. The next day, closed below the order block. What do? I just got out. Had to get out. I was just wrong on this position. The order block did not hold. I had a loss of 6.63%. Not fun. Did I hit my emergency stop? No, I did not. Right? My emergency stop was 1% below. So this was about a 0.4% account loss. So not great, not fun. Then it closed back in the order block again the next day. And then look what's happened. So Clearly, at the time, it's no fun, but you have to follow the rules. But now in hindsight, am I glad I got out when I got out? Yeah, you bet I did. You bet I am. So loss of 6.63%. So you see, not all of my trades are positive, but I can show you one thing for sure. If I'm in a position for a long time, it means it's positive. With my losses, I'm usually in them and out of them very quickly, right? I was only in this trade for 2 days. If I'm wrong, I'm usually out within a very short amount of time. But if I have a winning trade, I'm going to be in it for a long, much longer amount of time than my losing trades, and that is proper trading. Like Netflix. How long was I in Netflix? 2 days. I was wrong. Out. UNG. 2 days. Out. You know, you look at some of my longer term trades, like, you know, Shopify or oil or home UNH, many days, weeks, right? That's the key. And then let's go to Amazon, my last open trade. Okay, not Amazon, excuse me, AMD. AMD, here we have an order block. Move the order block into the future. In this particular case, we have the 100-day moving average, which is the red line inside the order block. Remember, key level within key level, okay? On the 18th of December, on the 17th of December, we closed below the key level, the 100. On the day that I entered, we closed back above it. That's a rejection. Sometimes rejection can be intraday or it can be day to day. Previous bar closed below, next day closed above. That's why I bought it. We rejected, that's deep dip buy. We rejected the 100-day moving average key level inside a order block key level. Okay, so I entered here 201.10. I position sized correctly. I placed my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below this 100-day moving average, the red line. So I have a good risk to reward ratio to start the trade. I place my 1.5 ATR trailing stop level above. Next day, takes off like a rocket ship. Multiple profit targets. The very next day, I get to trailing stop level, which is fantastic. Then we gap up here, another profit target. We move sideways, bump, 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 bump. And then here, this is on the 31st of December, is our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the position, which in hindsight was really good thing because I locked in a gain of 6%. Next day, takes off like a rocket ship again, selling into that strength. Next day, takes off like a rocket ship, so hit multiple profit targets into that huge move up before it reverses. Okay, then we come down, we come down, we come down. What happened on Friday? It closed below my line in the sand. It closed below my end of our stop with the 100-day moving average. I had to exit the trade. I exited the remaining shares of the trade for a gain of 0.98%, but I made a lot more on the trade. Why? Taking the partial profits into the strength. Whenever we had huge moves up, I was selling into that. And again, we have a close below the previous bar's low. I got rid of half here. So this is a very, very good trade. Just the remaining shares still profitable, but overall, multiple percentage move trade on this. And again, because of the rules. All right. So, but I did exit the remaining shares there, 0.98%. Oof, that was a lot. Oh, I have one more. I'm sorry. So I every trade I just showed you is a trade on the daily charts, but I also trade weekly charts. Weekly charts close on Friday, so you make your buying and selling decisions on Friday. Okay, I have been in this trade for months. This is the dollar, UUP. I entered here on the 11th of July, so July 7th at 26.31. Why? Multiple signals. First signal, see the order block from the past? We went in the order block, we closed above the order block. That's a rejection of the high of the order block. That by itself is a legitimate signal. In addition to that, look at the week before. We were under the 200 week moving average, then we closed above. So two primary signals: close under, close over the 200. That's a deep dip buy. And we rejected the high of the order block. So that's a high of the order block rejection. Two key levels, or two key signals. So I entered 2631. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this 200-week moving average. I placed my 1.5 ATR trailing stop level above, and here we go. Next week up, profit target. Great. Next week down, nothing. Next week significantly up, multiple profits, and I got to trailing stop level. All right, then we move down, and then here on the 15th of August is our first close below a previous bar's low after reaching trailing stop level. I take half of the trade off for a gain of 0.49%. I still have half. We move sideways for a month. Then this bar was significant because during the week we were substantially below the 100 or the 200-week moving average, in which case I would have gotten out because that is my stop. That's my end of bar stop level, right? But at the end of the week, it reversed back up, kept me in the trade, okay? And then next week, profit target. Next week, nothing. Next week, profit target. Couple weeks, nothing. Next week, profit target. Nothing, profit target, and we've moved down for the last, month and a half. And then this week, I hit a profit target on the way up. All right, so we haven't got to 65 RSI level, so the 5 EMA is not coming into play. Haven't got to the 70 RSI level, that's not coming into play. So the remaining shares that I have on UUP are up 3.7%, which is pretty good, I'll tell you, for a currency. So, okay, everybody, those were all the trades, the ones that I'm still in and managing, the ones that I got out for whatever reason. So anyway, I hope that was helpful for you to see how I'm entering these trades, why I'm entering these trades, and how I am managing them. So I do have 7 potential trades for next week, but before we get to those, let's spend a few minutes on trader psychology, and then we'll get over some potential trades for next week. Okay, so I was considering not talking about this because it's quite long. This is from Tony Stark, by the way, on Facebook. Really great channel. If you look up Tony Stark on Facebook, I read his posts more and more. They're always really, really, really good. And so I would recommend following him if you can. But as I read through this, I said, this is all so good that even though it's long, I'm going to take the time because he it's just so pertinent to trading and so accurate. And so I really appreciate Tony Stark posting this because it's such a great summation of trading. And so let's go through it. I think it's worth the time. And I think a lot of this will resonate with you as traders. It certainly did with me. Discipline pays you more than activity ever will. Discipline pays you more than activity ever will. Number 1, capital is precious. I only commit my money when the opportunity is clearly in my favor. Everything else is just noise and risk. So accurate, everybody. That's why when I enter a trade, I am looking for multiple confluences of signals happening at the same time. Then I know that the odds are in my favor. It doesn't mean that trade has to work out no matter how good the setup is, but the odds are stacked in my favor. And why get into a trade unless really the odds are in your favor? So capital is precious. I only commit my money when the opportunity is clearly in my favor. Everything else is just noise and risk and nonsense. Number 2, waiting is the job. I don't get paid for clicking buttons. I get paid for waiting, staying patient, and striking when the setup is right. As traders, we kind of always feel like we need to be doing something. Really, always doing something is not going to be good for you. Being patient, stalking, waiting, that is where you get paid. So let's read it one more time. Waiting is the job. I don't get paid for clicking buttons. I get paid for waiting, staying patient, and striking when the setup is right. That's a good one. Number 3, cash is a position. Being in cash is not a failure. It's discipline in action and protection between real opportunities. When I studied one-on-one with Dr. Alexander Elder, he told me, Greg, there are three valid positions. You can be long, you can be short, or you can be in cash. All three of them is valid. So if you don't have any positions, don't feel like you just have to rush into something because you feel like you have to make money. If there's nothing to do, don't do anything. Sit in cash. It is fine. It is valid. Number 4, quality over action. One great trade beats 10 average ones. Ooh, think about that. One great trade beats 10 average ones. I avoid wasting capital between the moments that truly matter. Unless you have a setup that really truly matters, don't do anything. That's key. One great trade beats 10 average ones. I've never heard that before. It's really good. And it's really great. So being in cash is fine. Wait for the really good one where you can really do well, right? So one great trade beats 10 average ones. I avoid wasting capital between the moments that truly matter. Number 5, long-term perspective. I know missed trades don't matter. Breaking discipline does, and it always shows up later in the profit and loss. It's true. Yeah, you're going to miss trades. I missed a trade on Costco. It got within $1 or $2 of where I wanted it to and just rocketed up. I'll show you that later. I didn't take the trade. I missed out on the trade. I had someone say, yeah, but I was so close anyway. I'm like, yeah, but it didn't do what I wanted a rejection with long-term megaphone trend line. It didn't do it. So I didn't take the trade. It's fine. It's totally fine. But if I would have broken my rules there, then I'd be more likely to break my rules in the future on something, right? So long-term perspective, I know missed trades don't matter. Breaking discipline does. And it only shows up and it always shows up later in the P&L. I used to be a professional athlete. I was a professional triathlete. And I lived at the top of this big hill. And every day when I go on my run, I'd have to run up that hill to get to my house. And every day I was like, oh, Greg, you've been working out all day. Yeah, you're tired. You can walk up the hill. I'm like, no, if I don't finish this every day, it's going to be easier for me in the future not to do it. It's the same thing in trading. I didn't break my discipline in my athletic training because I knew if I started, it was a slippery slope. And maybe the next day I walked up the hill. Maybe the next day I walked up the hill. Same with trading. If I took a trade that's not a legitimate trade and it worked out, okay, then I feel like, oh, yeah, I can do it again. But in the long run, it is going to affect your P&L. So stay focused, laser beam focused on your discipline. Number 6, rules create freedom. Because I know exactly what I'm waiting for, I don't feel pressure to trade every day. Does this resonate with anybody? You feel like you have to put on a trade? Yeah, of course. You're human. It's human nature. But most humans fail at trading because of this reason, right? Knowing exactly what you're going to do in a trade, if then statements, if it does this, I'm going to do that. If it does that, I'm going to do this. That is freedom, because then it takes away the impulsivity of just taking random trades and not really having a plan. Super accurate statement. Rules create freedom. Because I know exactly what I'm waiting for, I don't feel pressured to trade every day. You know who's really good at this? Steve Burns. Unless he has a legitimate trade, he doesn't do a thing. He sits in cash and he's happy as a cow, right? And the longer you trade, the more you'll realize what a true statement this is, as far as it creates freedom and takes the stress off. Number 7, discipline builds confidence. Every time I follow my rules, I reinforce trust in myself and in my process. Really good. Every time you go to the gym, you do it day after day, it reinforces your habit of going to the gym. You ever do that? You go to the gym all the time, then you take a break, and then you're like, I don't think I'm going to go, blah, 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 blah. It's all about habit, whether it's athletics or practicing your guitar or practicing whatever else in your trading. The more you do it, the more you follow your rules, the more it reinforces the trust in what you do, and the more it reinforces good habits. Number 8, mistake avoidance wins. Most damage happens between good trades. Discipline keeps me out of trouble when nothing is there. Okay, well, this kind of references back to waiting and capital is precious. But he's right. Most damage happens between good trades. You have good trades, and then you don't really have anything. And so you get in because you feel like you need to do something. But it really wasn't a AAA rated great trade, and they usually lose. And so you're just kind of giving up money in between good trades just because you feel like you need to do something, right? So just have the discipline to just only take good trades. Number 9, reward the behavior. I consciously acknowledge discipline days. That's how consistency is built, trade by trade. I consciously acknowledge discipline days. In other words, if there's no trade and you had the discipline to not take the trade, acknowledge that you followed your rules and be proud of yourself. Give yourself a little gift, reinforce it, right? Reward it. Reward, you go, you know what? I didn't do it. That's good, man. Listen, these 9 sayings here are fantastic. If you get a chance, go back and read these one by one carefully, related to your own psychology, related to your own trading. Meditate on these because these are really, really great. So thank you very much, Tony Stark. Please follow him over on Facebook. Okay, let us head over to the potential trades that I'm looking at for next week. Okay, so as I mentioned earlier in the podcast, every Friday night I go through my entire watch list of about 80 stocks, and I look for potential trades for the upcoming week that are not where they need to be yet, but close. And they are coming into areas where there are confluences, major support levels, all sorts of different things, RSI levels, major moving averages, order blocks, maybe double bottoms, bullish MACD divergences, all this kind of stuff. Okay. And so here I have 7 potential trades for next week. They're not there yet, but they're potentially, they could get there next week. And so I'll be watching all 7 of these carefully. Now, I mention this every weekend, but it's potentially possible that all 7 of these could trigger on Monday. And so you might ask, are you going to take all 7 of them, Greg? Absolutely not. I only take one trade. I don't care how many candidates I have. I don't care if all 7 of them trigger. I'm still going to take the time to narrow down the best one out of the 7. And how do I do that? I give each potential setup a quality score. For example, if it has 1 signal, I give it a score of 1. If it has 2 signals, I give it a score of 2. If it has 3 signals, I give it a score of 3, right? And obviously, I'm going to usually take the one that has a score of 3 over the score of 1 because the odds are stacking more in my favor. But there are other things we have to look at. You may have a score of 5, but the risk to reward's really bad. So then you may not take that one, right? So this is what I teach my students, everybody. I teach them how to look at these trades if they have multiple options and how to narrow them down. So what's the quality score? How many signals? What's the risk to reward ratio? I like to look at the longer term charts as well. If I'm trading a daily time frame, I may want to look at the weekly charts to see if I can see some additional confirmation on the weekly charts just compared to the daily charts. I like to look at relative strength. You know, if the market's down, but this particular stock's up, well, it's stronger than the market. So its relative strength is higher, right? So that is going to add some additional points to the report card of that one. All right. And so, like I said, this is what I teach. I mean, this is how I use it. This is what I teach. And speaking of teaching, you know, I teach traders all over the world. I've taught for many years. I've taught students from absolute beginners all the way up to the hedge fund level and everywhere in between. I teach a 20-hour course. It's a one-on-one course. I think the very best way to learn anything is one-on-one, not in a group, but one-on-one. So you can ask questions. You're not embarrassed to ask questions, right? And I have turned out some really, really great traders. So if you're interested, I do teach a 20-hour course. We have a lesson video call each week. It's 2 hours. and we do it for 10 weeks. And I teach you all the different setups that I use, all the rules. We do a lot of simulation trading. I throw a lot of curveballs at you to make sure that you are understanding what I'm teaching you. But my goal is by the time we are done with that 10-week course, you're going to be a really good trader. You're going to have a lot of tools in your tool belt, and you're going to have a skill that you can use the rest of your life. And like I said, I have turned out a bunch of really great traders. As a matter of fact, one of my recent students, Vivek, he messaged me last night with a potential setup, which is really great. I didn't catch it because it's not on my watch list, but I'm going to include it here in just a moment and show you his setup. Doesn't mean it's going to get there, doesn't mean it's going to work, but it is a really good setup. But if you'd like to be my student, I'd love to have you as a student. I will teach you everything that I know. All you have to do is send me an email. The email's in the link of this YouTube video. Reach out to me. I'll reply back. I usually just have a initial video call with a prospective student. It's not a sales call, I promise you that. I just want to learn more about you, your trading challenges, your goals, and it's a really good time for you to ask me any questions about the format of the course and so forth. But I'm telling you, it's money well spent, and you will be happy that you spent it, really. Now, that's the best option, the 20-hour course. I also have a really good online video course at udemy.com where I teach you the deep dip buy stock trading strategy. I've sold so many of those around the world. It's 9.5 hours, so it's substantial and it's very affordable. It's somewhere between $30 and $50. So the link to that Udemy course is in the description as well. But whether or not you do the 20-hour one-on-one live course with me or the Udemy course, either one of them's a really good. They're really good tools and really good way to learn about trading. So anyway, I hope to have you as a student. Just send me an email. Okay, let's start. Here we go. Like I said, I have 7 of them. They're not where they need to be yet, but let's take a look at the first one, Adobe. Okay, so Adobe. I am looking here at Adobe, the order block. Again, from a teaching perspective, why is this an order block? Well, over here, we have a swing low and we have a swing high. And then what do we need? We need another lower swing low. And then the price has to move up over that swing high to change market structure to the upside. Well, that happened here clearly. Swing low, swing high, lower swing low, market structure change. As soon as you have the market structure change, I know that the lowest closing bar prior to the market structure change, the high and the low of that is the order block. Well, here it is. This is the order block on 1120. The high is 323.18, the low is 312.09. This is a smart money area. Again, when this order block formed here, well, it's here, but it formed here when we took out the swing high, and then we're way up here. In hindsight, was smart money buying here when ultimately it got to here? Well, sure, obviously. Okay, so if this is smart money here, is it going to be smart money again? Maybe, maybe not, but more than likely it is. And we are starting to work our way back into the smart money area. Now, you know I like key levels within key levels, right? Order blocks by themselves are fine if they're not very tall. But this one's quite tall. I'm not going to buy a rejection of the high of the order block and then wait all the way down here for my stop. Again, key level within key level. Look here on the 21st of November. Big, big, big up bar. What did I teach you about big, big, big up bars? 50% of that big up bar, there will be some inherent 50% Fibonacci support. That's at 318.40. Boom, bring that into the future. So I have a key level 318.40 within a key level of the order block itself. Okay, so there are several different ways I can potentially get into this trade. The first one, not my ideal, but the first one would be if we come down and we reject the high of the order block. Is a rejection of the high of the order block legit? It is. But then you have to look at risk to reward ratio. If we rejected the high of the order block, then I could use the midpoint here, the 318.40 as my stop. That would be legit because from here to here is not that much of a risk. Okay. So first off, rejection of the high of the order block with the end of bar stop at 318, fine. Not the best, but fine. Alternatively, if we come into the order block and then reject the 318.40 level, that would be ideal. That would be ideal. And I've shown you earlier in the podcast multiple examples of how I've done that. So, for example, if we did this, I can move these bars here. If we did this, super legit. Why? Because it rejected the key point of 318.44 inside the order block. Does it mean it's going to be a positive trade? Absolutely not. But is my end of bar stop very close? It is, right? So I'm structuring a good trade with good asymmetrical risk to reward ratio. So either a rejection of the high of the order block using the 318.40 as a stop, or a rejection of the 318.40 would be a lot more ideal. If it blasts down through all of those, then of course a rejection of the low of the order block at like 311.67, that would also be a potential for me as well. So that's what I'm looking for on Adobe. Advanced micro devices. Okay, so I just got out of advanced micro devices. So why am I looking to get back in? Well, look, I got out, ended up being a nice positive trade, but I got out because it closed below my key level of the 100-day moving average inside the order block. If on Monday it closes back above, I could certainly legitimately get back in that trade again. And 204.82 is that level. We're at 203.17. So a close back above the 100-day moving average would be a rejection of the 100-day moving average in key level inside an order block key level. That would be super legit. So one option, a close back above the 100-day moving average, as long as it's not too far extended, right? It has to be a good risk to reward ratio, or a rejection of the midpoint that happened back here on the 25th, the 199.7 level. So that if we head down and reject 199.7, that could be a key level as well, and a good risk to reward ratio with the end to stop being 199.7. Or if it comes all the way down and rejects the bottom of the order block at 194.28, that would also be potential. So either a close back over the 100 is one potential, a rejection of 199.70, the midpoint line, is another potential, or close below the low of the order block at 194.28 would be potential. Okay, Amazon. Okay, I'm looking for Amazon on the short side at this point. I look back here to the bullish order block and the 200-day moving average inside the bullish order block. Yeah, worked out pretty well, right? These were the bullish areas here and here. As soon as they got back to them, they took off. But in this particular case, I'm looking to the short side. Look here. Do you see the bar with the red background? This is a bearish abandoned baby. We talked about bullish abandoned babies, but let's talk about bearish abandoned babies. Why is this a bearish abandoned baby? Because we gapped up, so sentiment was very, very strong. Boom, everybody wanted it. But yet, after that happened, the very next day, we gapped down. Remember what I told you. If you have a very quick and intense change in sentiment from bullish to bearish or bearish to bullish, that gives you a good idea, not 100% of the time, but more than not, where that stock is heading. So if you go very bullish to very bearish very quickly, very likely you're going to see prices lower in the future. Was it right? Yeah, certainly was right, wasn't it? Okay, so when I have babies, bearish abandoned babies or bullish abandoned babies, remember on the bullish abandoned baby, the high of the order block is the support. Well, if you have a bearish abandoned baby, the low of the bearish abandoned baby is a resistance. Well, that's the red line. This is the low of the baby in the past. If we get back to that area, which is 250, 260, very likely, not 100% of the time, but very likely, you're going to have significant resistance there. And if that happens, more than likely, you're going to be lower. So we are not there yet. I need Amazon to reject 250, 260, or in other words, has to go up to it and then reject it and close below. If that happens, because this is an abandoned baby, the way that I'm going to manage this trade is a little different. It's very simple. I'm going to put a 2 ATR stop above and a 4 ATR stop below. If I'm wrong, I'll lose 1%. If I'm right, I'll make 2%. And if we reject the bottom of that baby, in my experience, more likely I'll make 2% than I'll lose 1%. But you never know. But that's what I'm looking for. I'm looking for a rejection of the bottom of the abandoned baby that happened on 11/3/25. And if it rejects that, I will consider taking the trade 2 ATR stop above, 4 ATR profit target below. Okay, here is ANET. This is what my student Vivek pointed out to me, and it's perfect. So Vivek, thanks, bud. I appreciate this. I would have never seen this or found this or shared this on the podcast because I don't follow ANET, but it's perfect. Okay, look, we have a nice order block right here. Why is this an order block? Swing low, swing high, lower swing low, market structure change. As soon as the market structure change, I can identify my order block as the high and the low of this lowest closing bar before market structure change. Bring it into the future, and look what's residing inside the order block. Remember, I like key levels within key levels. Well, there's really nice key level. One, we have a 200-day moving average, right? Just that alone is a key level, but it's a key level within another key level of the order block. So I am looking for 3 ways I could play this. A rejection of the high of the order block, fine. Then I could use a stop below the 200-day moving average as my stop. That's fine. It's my least favorite. My most favorite would be a rejection of the 200-day moving average inside the order block. It's nice that that 200-day moving average is right there by the negative third ATR channel as well. So that really is a sweet spot right in there about 117. Or I could get the bottom of the order block, and I don't know if you can see this purple line here. This is the 250-day moving average coinciding with the low of the order block. Either of those are perfect. So 3 options: rejection of the high of the order block, stop, close below the 200-day moving average. Second option, rejection of the 200-day moving average inside the order block. End of bar stop would just simply be a close below the 200 in the future. Third, a rejection of the bottom of the order block, which dovetails with the rejection of the 250-day moving average. So it's a perfect deep dip buy / order block combination, which are my favorite. So thanks, Vivek. Appreciate that. And we'll see if any of those trigger. INDA. INDA is the Indian stock market. And we have an order block that we're coming into. As a matter of fact, we just bounced off the top of it on Friday, but that's not where I want to get. Again, why is it an order block? Swing low over here, swing high, lower swing low. Market structure change. As soon as you market structure change that, the lowest closing bar prior to market structure change, which is this dude right here, the high and the low, you bring the order block in there. What is lurking inside of the order block? The 250-day moving average. Key level within key level. Order block / deep dip by area. I am looking for rejection of the 250-day moving average, which is 52.86. We are at 53.16, so not that far away, but I'd be looking for a rejection of that 250 there. That's what I'm looking for. That'd be a great trade with a good risk to reward ratio. Doesn't mean it's going to work, but it's a good setup with a good risk to reward ratio with the odds stacked in the favor. Okay. Meta. Okay. Meta, it's unlikely that it's going to get here, but if it does, I will be looking for it. Okay, here is your order block here on the 20th of November. Why is it an order block? Because we have a swing low, we have a swing high, we have a lower swing low, we break market structure to the upside. The lowest closing bar is the order block. Boom. But I have a level inside at 595.30. What's that level? I don't see a big up bar. That's right. But we have an abandoned baby here. Remember, we gap down, followed by a gap up in a very short amount of time. What does that tell us about the future? It tells us more likely than not, price is going to be higher. Was it right? Clearly, it was. But remember, the high of a bullish abandoned baby is the support level. That's why I drew the line at 595.30. The high of the bullish abandoned baby resides now in this newly formed order block. So really what I'm looking for on Meta, and again, it's not likely that it's going to get there, but if it gets there, I want to be ready for it, would be a rejection of 590, 530 inside the order block. That's what I'd be looking for. Last but not least, Netflix. Okay, I got out of Netflix Friday for a loss, but look, just because you get out of something doesn't mean you can't get back in it. Again, we have this key level from the past, which is the $90 level inside the bullish order block from the past. Monday, if we close back over this $90 level, I could certainly consider getting back in that trade again. And then that $90 would be my new end of bar stop. If you have a good trade and it doesn't work out, don't be afraid to get back in the trade in the future if it's legit. It's kind of goes against human nature. People are like, oh, I lost. I don't want to take it again and lose on the same one, right? You understand what I'm saying. But really, in my experience and my belief, if you have a losing trade and you have another entry on the same symbol and it's legit, I get back in. I always do if it's legitimate. So, ultimately what I'd really like to see on Netflix is I would like to see Netflix gap up on Monday. Like the market cares what I'd like to see, right? It doesn't care one single bit. But personally, if it did, it would be great, because if it gapped up on Monday and closed above the $90 level, first of all, we would have a close back above 90 inside the order block, which is legit by itself. But if we gapped up on Monday, then we'd have an abandoned baby. See how from Thursday to Friday we gapped down? So we gap down. If we gap up, then we'll have an bullish abandoned baby inside an order block and a close above that key level. That would be delicious, right? So that's what I'm looking for, everybody. So I know it's been a long podcast. If you've made it to the end, thank you so much. I really appreciate it. If you found something of value, I really would appreciate it if you could hit the thumbs up button. Like I said, really helps out the channel, lets YouTube know that there's valuable content here. If I can help you with your trading, please let me know. I would love to be your teacher. I'll teach you everything I know. I also do consulting if you're interested in, weekly consulting, monthly consulting. I consult with a lot of people and I'll help you any way I can. But thank you for being here. I always like to leave off with, please try to go out and do one nice thing for another human being each day. It really would make the world a better place. If you have the opportunity to do one nice act of kindness for animal, that would be fantastic. They appreciate acts of kindness just like we do. And I think we'd make the world a whole lot better place if we could do that. So if you have any comments or questions on the podcast today, put them in the comment section. I'll do my best to get back to you. But enjoy the rest of your weekend. Trade well, follow your rules, and God willing, hopefully I will see you back next week, and we will see what happens with the existing positions and any new positions. So thanks a lot, everybody. Take care. Enjoy. Bye-bye.
U.S. government required stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.